Hello everyone, this is Gary Muir, your instructor. This is our last video for this course. We're going to be covering the remaining section of Chapter 10 dealing with the overhead variances. This actually then starts on page 543. And it goes to the end of the chapter, basically. So, which is on page 552. So, again, the reason we do this is that it would be really too much to have everything all from chapter 10. We will also be covering a portion of chapter 14, the basic cash flow statement. That should be somewhat of a review for everyone because we've had it in accounting 2 already, somewhat in intermediate as well if you've taken that course. So that hopefully will be a good one to end on for the course itself. The problem, the 25-point problem in this particular section of chapter 10 is also a TSA, and we have to be aware of that, so keep that in your mind as well. We have to have that 77% in order to maintain that grade that you have currently in the course. If that is not maintained, then obviously the recourse is that you get a D for the course itself. So keep me posted on that. If you have questions on that 25-point problem, it's very important that you reach out to me. All right, so for chapter 10, the overhead discussion, like I said, begins on page 543. The template, we're going to use another one similar to our material and labor templates that we used for the last chapter test. We're going to use one for overhead. And you'll see some of the same variance names that we had for the material and labor. There's a spending, there's an efficiency variance for the variable overhead. And then for the fixed, there's also a spending. And then finally a new one called volume variance. And with overhead, remember we're going to continue using the applied overhead for the amount that goes into work in process inventory. So we're almost going back to the normal costing that we did way back in chapter 4 when we did job costing and we applied overhead to a particular job. So that actually is a standard or budget amount, that applied overhead, that predetermined overhead rate. So I show the variance names here. This is listed on page 543. And we'll cover those in our templates like I mentioned. And also similar to our material and labor variances, there's someone always responsible, or who do we talk to in this case regarding a variable overhead spending variance. And in this particular overhead assignment process, and you'll see those questions on the multiple choice questions on the exam, is the production department, is the person responsible for that variable overhead spending variance. So I just wanted to point that out. The spending variance is talked about on page 546. So take a look at that so you understand what variances they're talking about. Obviously, when you're dealing with spending, you're talking about price paid, right? What was the actual price paid versus what was the budgeted price? And what makes this variance computation so difficult is we're not dealing with a couple items. We're talking hundreds of different things that make up our variable overhead. We're talking utilities, you're talking supplies, you're talking maybe the wages of the maintenance crew. So you've got a large number of items that are budgeted and you have to compare those items against each other. Efficiency, same thing as with labor. It's how much time, right? Time is measured here. This too is talked about on page 546. Production manager is responsible, and we're applying the overhead based on direct labor hours in this section. So that measurement, that driver, that activity driver then is going to drive the cost of our overhead. So that's what we're looking at here. Then we jump to the fixed overhead discussion, which begins on page 547. And again, like our variable counterpart, we're looking at two different types of variances. And the first, again, is price or spending variance, comparing what we actually spent to what we planned on spending. And remember what our fixed costs are. There are the leases, the rents, the depreciation. Obviously, that would not be a factor with spending. Supervisor salaries, anything with a salary associated with our production process. Those are all fixed costs. So we're going to compare those actual prices we paid those individuals or for those things compared to what we plan to spend. And that's the goal here with standard costing. And like our other analysis, a lot of this is beyond our control. We've got weather issues, so maybe we had much more cleanup or whatever due to snow, that sort of thing. And who's responsible for the volume variance? Now, that's the fourth variance, obviously, volume variance. It is a production control, right? Oops, excuse me, I hit the board. That is a production variance. And with fixed overhead, this is a measurement of capacity utilization. And capacity means how many production units. Capacity. What is our normal capacity based on the number of machines we have on the shop floor? How does that production budget compare to what we actually used? Or actually produced. That's the measurement of volume variance. It's a capacity measurement. And I think once we get into our problem here, I'll explain in more detail what each of those variances are, and then obviously how they're computed. So the sample problem that I did choose to discuss these four different variance types is problem 72. I'm going to jump to page 581 in our textbook to discuss that. So I'm just jumping there now. Okay, with every one of these problems, and I'm just going to move this up a little bit more. Obviously, they're going to give you information on both types of costs, both variable overhead costs and fixed overhead costs. The book also talks about the term normal production volume. So I'm just going to put that on here. Normal production volume was 120,000 units. Now, normal production volume is not actual production. There's a huge difference there. Normal production volume is designed for or determines the budget. It's a budget number. And it's used to determine our standard variable overhead rate and standard fixed overhead rate, the green boxes. So this budget number helps us get our SVOR, standard variable overhead rate, as well as our standard fixed overhead rate. If you remember, in Chapter 4, I know that's a long time ago, but in Chapter 4 we talked about a predetermined overhead rate. Well, that's what our standard variable and standard fixed rates are here, is a predetermined rate based upon what? A budgeted level of production, which in this case was 120,000 units. So it talks about that in the bottom of page 581. It also says, hey, it takes, or it should take, right, 5 hours to make 1 unit. That's in the first paragraph. Second, it gives us our budgeted fixed overhead, 2.16 million. You'll see that in our budgeted fixed overhead template here. I'm going to have to use my mouse. So here we are. So this, oh, I'm sorry, my board just went dead. Hold on one second, I'm going to have to pause my recording. All right, guys, I'm back. Sorry for that. My pens are not working for some reason, so I'm going to have to use my finger. So you'll see the 2.16 million. It's right in the middle. This is a budget number. I just need to get my, there we go. It's our budget number, 2.16 million. It's fixed overhead. And the other cost, our other budget number for variable overhead is 1.44 million. Well, you notice the 1.44 million is not even on my budgeted variable analysis here. And to get that, guys, let me just take a look at this. I'm going to create a new page here. So let's just assume this is the variable overhead SR, standard rate. And that is, again, some budgeted level of dollars on top that we've determined at the beginning of the year, along with a budgeted level of activity on the bottom. Now, the book is saying, hey, for the year, our variable overhead is budgeted at 1.44 million. So we put that on top, and we're going to divide that by, again, this budgeted level of activity, which they are planning to produce 120,000 units. And we are going to use direct labor hours here, the standard again, to come up with our denominator here located underneath. So this in total then gives us 600,000 budgeted level, right? This is a budget number of direct labor hours should be incurred during the year. So we simply take a division here of the 1.44 million divided by the 600,000, and we get 2.4, the standard variable overhead rate per what? Direct labor hour. So this is our SVOR, standard variable rate, that we use in our templates. Now we could do the same thing for not only our variable overhead, but also for our fixed overhead. So let's just do that. I'm going to change colors here. Let's try this. Let's use the same, how about let's just use the same designation that the author uses. I'm going to go back one slide here. SFOR, make sure we use the same rate. SFOR, the F meaning fixed. Well, there the budget level was 2.6 million, right? So we start with that. This is a budget number, just like variable. And then we're going to divide, again, since we're using the same driver, which is, again, a budgeted level of direct labor hours that we plan to have, right, 5 hours per unit, we plan to have during the year. So here, our SFOR rate is going to be, we're just dividing this out, 3.6. So 3.6 is our SFOR rate. This is a predetermined rate that we're going to use throughout the year. And if I go back to my template here again, just reverse, I can see that 3.6 in the green box for my fixed overhead overhead rate. Remember, the standard is always set before the year starts. This is no different. It's just that now we're looking at not our direct material and labor costs, we're looking at our overhead costs. So once we get those standard rates, now we can put in the actual hours. Let's just start up here. If we turn the page to 582, it says during the year they produced 118,600 units, worked approximately 592,300 hours. Well, in my yellow box, here's my 592,300 hours, and I'm using my 2.4 as my variable rate, my standard. I come up with 1.421,520. That number is compared to what? Remember this term, applied variable overhead. We apply this to what? Work in process inventory. So here again, just like with materials and labor, this 1.423 million is what we're going to put into work in process inventory here. That's the debit entry. And I'm going to credit what? The manufacturing overhead control, just like we did in chapter 4. That's the entry to record and put it into our WIP account. Now, the standard hours allowed, remember that from last chapter test, is computed the same way. We take our actual units, 118,600. Remember, what did we plan for? We planned for 120,000. So we're down, we didn't produce as many units as we had planned to produce. Never a good thing in production. We were planning to produce 120 and we're below that. Well, guess what my volume variance is going to be? Unfavorable, 25,200. I had the capacity to do 120 and I only did 118.6. Not good. But going back, that standard hours allowed is 593, and you can see here, I can use it not only for the variable overhead computation, but also the fixed overhead computation for the applied amount number. So, that 1.423 million is compared to the 1.421 million, right? I'm comparing these two. I have a difference of our variance amount of 1,680, and look at my hours. I actually had 592. For the units that I made, I was supposed to use 593. So here again, less means good, right? I was more efficient than what I thought I would be. That's a favorable efficiency variance. Now I go on the other end, look at my actual cost, right? And that is greater than, as you can see here, by $1,280. Unfavorable. And what's the cause of that? Well, we really don't know. It could be due to waste, rework. It could actually be the price that the vendors are charging us for supplies, and maybe there's some maintenance supplies in that number. So there are some things influencing the difference again between what we planned and what we actually incurred. Going down to the other variances, look at fixed overhead. The book tells us they actually spent $2,150,400, right? That's a difference when compared to $2,001,600. The actual is less than our budget, which gives us a favorable spending variance. So here again, we did a great job on what we paid for our salaries, what we paid for rent or leasing and so forth. We did a good job there. That shows a positive thing, right? But we had problems on our production, our capacity measurement. Look here again. We talked about this earlier. We planned to make 120 compared to what we actually made. That gives us the unfavorable volume variance, capacity measurement, and that is never a good thing. So here the volume variance is greater than our spending variance in total. We can net the two, right? Make the difference 15,600. The unfavorable is larger than the favorable, so the total fixed overhead variance is unfavorable at this point. So just as a review then, guys, be aware how to get the SH. The standard hours allowed. You have to use actual production. That's the main thing. Critical. And then 5 hours was the allowed hours per unit, right? To make 1 unit. Also, what's very important, for the fixed overhead, the budget amount, we have to give you this in most cases. So this is a given number. Remember, it's a budget number, not the actual. It's a budget number. And also remember, the variable overhead section does not have that budget number anywhere on the template. So there is a difference between the variable template and the fixed template. Just be aware of that. And then also remember, with these computations, remember that the rates, this standard rate for variable, the standard rate for fixed, is always based on budget numbers. Budgeted dollar amounts on top, budgeted activity level on the bottom, and the activity level will always be direct labor hours in this overhead section. So that's kind of nice. It's not based on direct labor dollars or some other type of driver. It's strictly going to be direct labor hours for computation purposes. So remember those things. Here again, if you have any questions on any of the numbers, computations, how do I get started, let me know as soon as you can, please. This is again just a review of those standard, how did I get those numbers. I'll just leave that out there. It's just a replication of what we just did. And hopefully it's a little cleaner so that you got a reference point to look to when you're solving the SVOR or SFOR amounts in your other problems. I do have another template here. This is problem 73, already completed. Do this for practice. Again, I tried to list how or where I got the numbers. Let's just look at the computations here. I got a budget number of 576 for the fixed overhead. And in this case, I'm just reading the problem at this point. They only gave us the actual numbers. So in this case, the variable overhead, coming back out here, they gave us the 860,000 actual. So this is given in the book. The 82,000 hours is given in the book. And they gave us the actual production units, right, was 50,000. So this was given to us. In our standard cost card, it says here that we can make, or should be able to make, 1 unit in 1.6 hours. That gives us then the standard hours allowed, both variable and fixed. They're both the same number. So the only thing I don't have to solve this problem is the green boxes, which is the overhead rates, the 10 and the 6. And if you look at the standard cost sheets, that's given to us in the problem as well. So just a way of basically locating where is this found in the problem is sometimes a bigger task than actually doing the computation or filling out the template. So I wanted to show you this because it's a different view than maybe some of the other problems you'll encounter. What does SVOR mean? Well, that's the standard variable overhead rate. What does SFOR mean? That's the standard fixed overhead rate. And where do I find that? Now, remember last problem, the problem didn't give us those numbers. We had to compute, right, the SVOR and the SFOR amounts. We had to compute those using our budget numbers that were given. This problem here is similar to your 25-point problem. You're going to have to compute the SVOR and the SFOR rates, the predetermined rates. Unlike 73, they give them to you. So be aware that will be changes that you'll see throughout the chapter questions. And here's another one just showing how did we get to where that $6 amount was found. So I just grabbed the budget number 576. I divided it by the level of activity. We plan to make 60,000 units here. That's our practical normal volume, our capacity amount, right? And obviously we only made 50. Well, 50 is less than 60, so guess what? My volume variance is going to be unfavorable. And again, production, that's a huge, big deal. Because if my production level isn't as great as my budget level, my cost per unit is going to be higher than the standard cost per unit here of $74.80. That is a huge problem, because guess what? We're not making enough money on every unit that we sell then. Because remember, our sales price is based upon our cost per unit, right? So hugely important that we hit that production volume. All right. So let me know how the templates work for you as you go through chapter 10's remaining pages. Jumping to chapter 14 then, this chapter begins on page 791. And the section that you will be responsible for in chapter 14 goes from page 791 all the way up to because we're not doing the direct method, we're only doing the indirect method, up to page 801. So basically we're looking at 10 pages here. So page 791 to page 801. We're going to only do the indirect method of cash flows. And cash flows, the reason we're hitting it again is really cash is king. If I run out of cash, it's dire, right? And look at what happened to GM. They weren't losing money, they just ran simply out of money regarding their about 10 years ago, 2008, when they went bankrupt. And they went bankrupt because they were building cars and paying for all their supplies, materials, labor, and so forth, and they weren't selling them. And again, you can only go so long doing that, and that's what happened in GM. So cash flows for any company is so important. And to understand where your cash comes in and where it goes is a great start in understanding or the importance of cash flows. So it talks about why do we do cash flow statements. Well, it is GAAP or required by the SEC, obviously. You don't need it for the IRS, obviously, but many investors want to know how that cash is going and where it's being spent, right? And how it comes in. And the indirect method breaks out the template. I'm going to give you another template here between the sources of cash and the uses of cash. So there's 3 sections here, are operating, investing, and third, finance. Most of the information required is in that operating section, and investing happens around the sale or purchase, right, of long-term assets. Sale and purchase of long-term assets. And then the financing section is the debt or stock issuance versus the retirement. And we have a little bit here of dividends that are in the finance section going out, right? Uses of cash. So the rest is all in the operating section. So you will on the exam have to distinguish between obviously operating and investing, and then also whether it is one of these 3, whether it's operating, investing, or financing, and whether it's in or out, obviously. So the 3 activities, example 1, you can practice this yourself. This is on page 793, and it does a nice job showing you what is the activity, the transaction that took place. For instance, number 1 here on page 793. My pen started working, kind of. Maybe not. Sorry about this, guys. I'll use my finger again. Page 793, you notice here, issuing long-term debt. Well, debt is a finance, right? So that's why it's in the finance section. And I'm issuing it. So here again, terminology is really important. Issuing versus retiring. That's difference, right? Issue, I get the money. Retire, I'm spending the money. And just get used to identifying the transaction, and then where on the template, where does it go? Is it going in the operation? Is it going into the investing or in the financing? So review that. I also have a problem here. Problem 33 is an example of it as well. Practice using the example here. Verify your answer. And I think, again, this hopefully should be a review for you. As I mentioned, we're only doing this, the indirect method. We are not doing the direct method. In my 30 years, I've never used the direct method. I've only used the indirect method. The indirect is much simpler. It's an easier way to analyze our cash flows, so that's why it's predominantly used. It's just that much simpler than the direct. All right, problem 48 is an example that you can compare your work with mine. It begins on page 828. It shows basically a balance sheet, right, and an income statement in the template. And it's a little more complicated than just giving you amounts, right? So as you can see, there's a gain on sale. Now, what we're trying to accomplish here is start from net income. That's the 450,000. We got this from the income statement. So this is given here. And then from that number, we convert it from a somewhat non-cash flow type number to a cash flow number. So that's why we're adding back depreciation. Depreciation is a non-cash expense. Just like the gain on sale is a non-cash event. So we are reversing out those two effects on the 450. So I'm adding back 125 for the expense amount, and I'm subtracting out the gain that's in that 450 number. So those adjustments you'll predominantly see almost every time. For sure, depreciation will always be a factor when we're doing our indirect method. Now, we next look to what? Our current assets section of the balance sheet. And there are 2 years here. There's a 2001 and 2002, right? We're looking at the difference here. So last year, we ended the year with 350. We currently have 281, 250. That's a difference of $68,750. And you notice that the receivables are decreasing. Well, that's a source of cash. If I'm collecting more than I'm incurring, that's a source, and that's why we're adding cash to that number here for accounts receivable decrease. And you do that for each current asset and for each current liability. Only the current section. The next current asset is inventories. Here, last year we were at 125. This year we're at 150. Well, that's not a good thing, right? We increased our inventories, we spent money, and we didn't transfer it into a sale. Well, that's going to put a drain on my cash flow, so that's going down. I don't see any other current assets, so we jump to the current liabilities. Here, I only have one, accounts payable. That's the only one. Once we hit mortgage, that's a long-term. That's long-term debt. So there, we did what? We had 300,000 last year. We went down to 237.5. That's a decrease. That is a drain, right? We paid more in our liabilities than we actually incurred. So that's a use of cash. So at that point, we get a subtotal here, combining, starting with what? Our net income of 450,000. I add the 125, I subtract the 50, I add the 68,750, and then the last two I'm subtracting to get my first subtotal, net cash flow from operating activities. So even though my income statement shows 450,000, cash flow was very positive, right, at 506,250. So that's a good sign. Our operation is generating lots of cash, $500,000 in this case. So obviously we did some spending, right? We did some purchases and sales of equipment. Now, if we look at the plant and equipment, it went up 25,000. Well, wait a minute. Why do I have two lines for the net 25? So I must have spent, what? More money than what I had sold, right? So in this case, I also sold some land, or purchased some land, I'm sorry. 1 second, please, guys. Sorry, guys, I had to review this purchase and sold equipment for a minute. We have to go down to the bottom here where it says other information. It says equipment with a book value of 125. was sold for 175. Original cost on that equipment was 225. So let's just look at A here. So I did another sheet here of how this works. So here, I originally had a 1 million in my account in my planting equipment. I took out 225. That was what was sold. That was the original cost of that equipment, was 225. Well, I don't know the purchase amount, but I do know that it went up 25,000, right? We talked about that earlier. It went from 1 million to 1,025,000. So that is a $25,000 change. So that purchase must have been 250. So that's what I'm putting in here. I'm spending 250,000 on new equipment. Now, my next problem is, well, okay, if my equipment was sold, this is the cash that I'm spending here, or receiving on my sale, was 175,000. I knew I had a gain, right, on the sale of equipment of, where is it, 50. So that must mean my book value was around 125. So now I have a template for that as well, right over here. My book value was 125. I sold it for 175. That's the $50,000 gain. Well, it says here the original cost was 225. How do I get to a book value of 125? The depreciation then, the accumulated depreciation then must have been 100 in order for me to have a book value of 125. That 100 is over here. So if you look on the income statement then, you'll notice that the depreciation expense was 125. So if I look at the balance sheet, the accumulated depreciation at the start of the year was 500. It jumped to 525. It ties out, right? It comes out. So if I take the 500 plus the new depreciation minus the accumulated depreciation on the equipment sold, gets me that 525. So there is some work when you're looking at sales of long-term assets. You may have to compute the book value. You may have to determine what was the accumulated depreciation on that asset. You might have to compute the gain or loss yourself, right? And remember, whenever you're doing a gain on sale or a loss on sale, it's always the selling price. In this case, it was 175,000 minus the book value, which was 125, gives us, in this case, a gain on sale of 50. So they're not always going to give you the gain. They're not always going to give you maybe the book value. Each problem is going to be different for you. You just have to know, how do I get book value? How do I compute gain or loss? Using the information that the problem gives you. So that is probably the most complicated area on these cash flow problems. So once I have the purchase and sales and another purchase here of land entered for this particular section, it comes again with another subtotal on the investing. So we have the 5,600,000, 5,006,000. How about 506,250 operating positive cash flow being offset now by the 293,750 investing spent, right? Investing dollars spent. The third section revolves around our debt, our mortgage, and you can see here on the long term, our mortgage went up from 0 to 250. Well, we must have issued a mortgage of 250. And in the notes in letter B, it talks about dividends paid, 225. So we use basically the mortgage probably to finance the land and so forth, but also to pay the dividends probably. So positive 25,000. Now if you look at the cash amounts here, beginning and ending, you could do a self-check. In this case, I started with 112, 500. I ended up with 350. The difference here, right, of 237, 500 is exactly what I come up with when I compare or add up the numbers here. So if I take 506,250, that's a positive cash flow. I subtract my investments, net, 293,750. And then finally on my financing, it's a positive cash flow of 25. If I do all three of those, I'll get the same number. That's that self-check, that 237.5. So that's the requirement for chapter 14. I have these templates, guys. Let me just give you a look here. Oh, I don't even have my internet open. Let's go there then. I'm just going to minimize this. I don't think I have anything else. Nope, that should be it. So let's look at my Blackboard shell. It won't take me long to get there. And I go into Blackboard. There are templates there that you can use. The ones I used today are out there. They're, I know they're kind of dated fall of 2015. There's really no need for me to change it. And I don't see, I'll have to get out here yet, the indirect method cash flow template, unless I have it down here. But I don't think I do. Let me add that quick for you. Also be aware for problem 74, it's a TSA as well. It's on the overhead section, and again, please maintain that 77% on that particular 25-point problem. And since we're touching on two different chapters, 10, the overhead, 14, the cash flow, remember that I split the 5 points, 2.5, 2.5 for the adaptive study plans. There's actually 2 for this section of the course. So be aware of that. The rest is pretty similar, and then the exam is at the end. So let me know how you're doing with your problems, your assignments, your CNOW. If there are any questions, please let me know as soon as you can. Thank you for your time and have a great day, guys.